All right, gentlemen, we have the task of separating a 401k or any sort of qualified plan from the idea of investing in a property, a 401 condo, 401 lake house, beach home, whatever it may be, right? And so what I want to do is to start out saying, how are these two alike? How is a 401k and a 401 beach home, lake house alike? Stallion, you want to go first?
I'll just take the softball, okay? Put it up on the tee. This is super easy. Both of these things have a growth mechanism, right? A lake house is based off the current market value of the other homes in the area, whereas 401ks are based off of the stock market, right? Which way are they going? Both of them can actually lose a little value, but they, over a long period of time, historically have grown. So I think that's an easy comparison right off the bat.
Okay. They both have the ability to grow different elements. Got it. How about for you, Mark? Give me an example of how a 401k and a 401 lake house are alike.
Well, if you listen to our podcast long enough, you know that one of the things that we really like is access to cash. And where the 401k versus a 401 beach house or maybe hunting lodge, I could see either of those working in there, a snow chalet, if you will. There are definitely opportunities and provisions for accessing that capital. Let's take the beach house, for example. You can tap into the equity within it. You can get a home equity line of credit. You can do a cash out refi. So you have potential opportunities to extract cash out. The 401k has some emergency provisions. There's a hardship provision. There's a first time home buyer provision. And there's also a loan provision that's inside of it. Where one of the things that we get challenged with is when you start playing in other people's pools, you have to play by their rules. And so, poet, I didn't even know it, just rolled right into that one. Come on, give me the W for that. I'll take it. But when you're looking at a qualified plan, it's not up to you how much you can borrow. And it's not even up to you if you can borrow. You've got to go to the plan administrator. You've got to play by their rules. And if you didn't know, if you were trying to take a loan from a 401k and they did have a provision that would allow you to take a loan, there's normally a restriction that says up to 50% of the value of your 401k or up to 50 grand, whichever is less. So imagine you've got hundreds of thousands of dollars you've built up inside of this thing and they say, wow, that's fantastic. Yeah, we'll let you take out 50 grand. So that to me is really kind of a kick in the groin. And I felt that one firsthand when I tried to actually access some cash and I figured that part out, the 50% or 50 grand. Whereas on a home loan, right, it's normally 80% LTV, depending on what you got going on. If you've got a HELOC, they might do 75% or maybe even up to 90, depending on who's in power in the administration and how much they want to, open those floodgates. But you are playing by other people's rules. And I think that's a huge takeaway for both of them. And there's pros and cons of both sides. But I think in this example, I'm going to say that the beach house is giving you more access with maybe some fewer strings attached.
What's the most important resource that you have? If you really thought about this deeply, I think you'd come to the same conclusion that Joey and I did. It's time. In our newest book, What's Without Wall Street, the 3 Steps to Financial Freedom Through Passive Income, we talk about how are we tracking that time? What is the thing that we can do to get more of that time back?
That's right. If you've ever been listening to our podcast and thought, man, it would be amazing if I could take all the things that you guys have learned over the last 10 years and just summarize them, put them in some way to easily digest them and take action, that's what this book is all about. You're not going to want to miss it. Go to wealthwithoutwallstreet.com/new book and get your copy today.
How about for you, Ernie? Give me a way a 401k and a 401 lake house are alike.
Right. So when we're using these things, let's focus on the 401k for a second. Person who has that, who wants that, one of the big things that is often talked about is the tax benefits of using a 401k. And I want to share with you, if you didn't know, that there can be significant tax benefits to having a 401 Lakehouse as well.
Mm.
With a 401k, a SEP IRA allows you as an income earner to take a portion of your income and put it into that vehicle, into that tax qualified plan, and take that income off the taxable table, therefore reducing your tax liability for the year, which seems like a huge win and is often talked about like it's a great thing. When you buy a lake house, it might not be obvious to you that you can get significant tax benefits to that as well. And here's maybe one of the biggest opportunities that exists, in that if you purchase 401 lake home, by the way, we're just talking about a lake house. There's no tax qualified lake houses. But if you purchase one of those and you use it as an investment property, it's possible for you to use the depreciation schedule on that house and do a cost segregation study and accelerate that depreciation schedule. And what that does for you is creates a big loss, big tax loss for you in that current year, creating oftentimes a much bigger tax reduction than what you're able to contribute to a 401k, which is like $23,000 this year, or to a SEP IRA, which is like $69,000 this year in 2024. So there's a huge, tremendous tax benefit to the 401 lake house that might not be so obvious, but if you think that way, can be bigger and better than the qualified plan.
I love that. So we have growth, how they're alike. We have loans that they're alike. We have tax deductibility, and there's a hatred of how they're alike. You're like, what are you talking about, Bryce?
I'm sorry.
I know you dislike a 401k. What do you hate about a 401k house? Well, here's what I hate about the 401 lake house is, depending on where you get it, you can have one of those alphabet soups there as well, and they're commonly referred to as an HOA, right? Like everybody ever had an HOA that you didn't like? Yeah, I've been there, right? Lots of issues that you're like, I don't want to put a sign in my yard. I don't need the sign in my yard, but they want you to have the sign in the yard. Then they don't want you to have the sign in your yard. Then they're like, your trash can's been sitting on the front too long. Hey, by the way, you can only use this architect versus this architect. Yeah, I have a dislike for HOAs. Well, the other, 3-letter thing I have a dislike for is CFP or CPA or CFA or financial advisor. I have a dislike for them because those are the people that typically manage a 401k, right? Like all those money managers, I have a dislike for them, just like I have a dislike for the HOA. And you guys can probably relate, because sometimes that they say one thing and the market and everything else does the exact opposite. And you ask questions, you don't get exactly the right answers that you want. So I have kind of a hatred for, maybe some of the management of both of those areas. So that's how they're alike. I know that's probably not what you guys are looking for, but just wanted to share my input. How about for how they're different? How is a 401k and a 401 lake house different? And I think this is where we're really going to get into maybe why we're getting into this topic. While we did our best to try to share how they're like, Stallion, how are they different?
Well, I'll tell you the number one difference, in my opinion, is I'm scrolling through my phone right before we jump on to this podcast, and I'm trying to let people in our community know, hey, we're going live to do this podcast on the 401 Lakehouse. And you know what I see? I see dozens and dozens of pictures, right? Memories of having been at your 401 Lakehouse, and the times that we're doing wake surfing together, and the times that we're having our mastermind members there, and the times that our families are together at these type of things, and the relationships that come from that. And I'll tell you, there's not one picture of a statement from the 401k that I don't have anymore. Right? And before, when I did have a 401k, there was no statements or anything that I wanted to share with anybody else. And to be honest, I didn't want to look at them myself because I didn't understand them and they were losing money. So That's a major difference that you can't always necessarily even put a dollar amount on, but you and I both know makes life rich. And so, anyways, that's a major difference in my opinion.
It definitely, right? Not many times have you sat down around the table with your kids, your grandkids, maybe if you have them, and you said, just admire this amazing 401k statement. This is, I mean, can you guys even like imagine how good this is as compared to what you just said today? Like the pictures, like there right now, you and I have a WhatsApp chat full of pictures from where we were just at a Lakehouse where they were guys were sitting there on, you know, the back porch having a good time, sitting around at the dining room table. We went out on the water, all those memories that have been made. I love that. How about for you, Ern?
I'll stay on taxes to keep it congruent. How are these things different? Well, we talked about the supposed tax benefits of the 401k that people think and the reason that they would get into them. But did you know that when the money comes out of the 401k, it is taxed? Picked up the deduction when you put it in there. When it comes out, it's being taxed. That's not fun. Sort of like, hey, you want the good news first or last? You know, it's like, oh, I'll take the bad news last. Well, the time comes to get the bad news, you really don't like it. I got to pay taxes on this. I thought my balance was X amount of dollars. Let me just go ahead and chop that in half. That's really where you're at. Not to mention that if you take this great thing, you talk about that statement, Russ, around the table. Can you even imagine how good this is? I can't wait until my children inherit this thing. When they take over that thing and the money comes out, it's still taxed.
Mm.
And right now, that money's got to be out within 10 years. So how long can you keep that great thing? Well, the money's got to come out. Whereas you take this Lakehouse, you have it and you're using it. Did you know that if you build equity in that house, you can cash out refi and the money that comes out of that is tax-free? Did you know that if you pass on that house, your children inherit it, that they get a step up in basis? Which means that if they sold it, they're not going to pay taxes on the entire gain that you experienced but did not realize because you kept the house and kept using the house and intended for them to keep using it. They get a step up in basis for that, which, by the way, if you do accelerate the depreciation and you pass that down, you're not worried about the depreciation recapture. So that protects you against the appreciation and the depreciation recapture. There's some benefits there. When we look at the 401k, I don't see it. It's bad news on the back end. It's good news on the back end of that Lakehouse.
Yeah, we've actually had a CPA tell us the worst asset to own when you die is any form of qualified plan, 401k, SEP IRA, simple, whatever it is, because not only do you pay the ordinary income tax, but if you have a taxable estate, then you end up getting maybe somewhere between 7 to 10% of it left to the heirs. That's a terrible asset to own.
How many
Mark?
people, Russ, do you think have heard that sentence that you just said?
Probably very few.
Well, there's 4 of us here, so I mean, everybody's heard that it's such a great thing, and the tax deductions on the front end, and you don't pay taxes on the growth, and it's for your retirement. So awesome. But what you just said is that inheriting is the worst asset you could possibly have. That just stood out to me.
Well, I mean, here's the thing. I know there's somebody going to listen to this and be like, yeah, these guys are hacks. They don't know what to talk about. Don't take our word for it. Call your accountant, call your CPA and say, what would be the absolute worst asset I could leave to my kids? Like if you could think through all the assets that exist out there, what would be the worst one I could leave to them that most people already own, right? Like that way you can limit their imagination, right? Like what's the worst that could be left to someone? And my guess is they're not going to say real estate that was, paid off and that had a lot of appreciation in it, because they go, oh, they get that step up in basis Ernie just talked about. Let's see if they talked about the asset that has 100% ordinary income tax on the distribution of it. And if they were successful enough to have this taxable estate that would also have to pay that as well. All right, Mark, how about for you? How are they different?
I'll keep driving the access train. Russ, let me just ask you a question. Do you think it's selfish of you to want to be using your lake house now and not waiting until you're 59 and a half?
No.
Because, I mean, if we're comparing the two, the 401k, the qualified plan, has a provision that it's not supposed to be tapped into. It's really not accessible until you're 59 and a half. And if you do, you get a slap on the wrist, you get a penalty. And if you're still an active employee with that company and it's a 401k, you actually can't use those dollars. You can take a loan provision that we talked about, right? You can take an emergency hardship. You can do first-time home buyer. But last time I checked, a 401k is not keeping the lights on if I take a pay cut at work. The 401k is not creating cash flow for me today so I can use it and enjoy it today and acquire things today I don't know about you. If I had a time machine, I'd go back and buy a whole bunch of stuff right around 2020, 2010. There's some great moments in time, but we've seen what happens, right? Inflation, cost of goods, and so forth. And so what I want to stick with is access of, when do you want to enjoy these things? Do you want to buy this lake house and put it on the side and put a lock on it, a key, and have a guard around it that says, nope, sorry, you can't come in here until you're 59 and a half? Or do you want to start using things today while you're still young, able, fit? You think about, wouldn't it be great if you could enjoy these things with the people you love today, as opposed to waiting to a point where now you're maybe not able to enjoy them because maybe you can't walk down the hill to the lake house. Maybe sitting on a boat for a while isn't something that you really want to do because your body just can't handle that, right? And so whatever those restrictions are, use it today. We're not guaranteed tomorrow. You only have today.
No, you're totally right. We want to be able to use things and enjoy things now. And the concept of constantly putting them off, unfortunately, we don't know, can we use them? I firsthand, as we were talking about a lake house, right? Like we made a decision to sell a lake house that we owned to build another one because we wanted to benefit our parents, to be able to have an easier way for them to get down to the water because it was kind of steep on the lot that we had. And 3.5 years passed by between when we sold it and when we were able to use the new one. And 2 of the 4 parents will never be able to use it. One, because one passed, and the other, their health is so bad that they're just not ever going to be able to use it. And I think about that, like we don't want to pass up time, right? Like I now have a kid that's in college, right? I will be going to our lake house here this weekend, and she won't be coming with me, because this is the first weekend that she's in college and she'll be doing her college thing. So we think through life, it happens so fast. And the ability to use things. So the money that we put in our 401k is not benefiting us until we're 59 and a half or after, right? Till we've separated service with the company. Well, for me, I want to talk about contributions, right? Like you think about the contribution limits that we have when we're investing into things. So in a 401k, do you guys know what the limits are to be able to contribute into a 401k today?
1 in 9.
I think it's, go ahead. What'd you say, Aaron?
1 in 9.
So you can put up to 23,000, right? And then there's some catch-up provisions. Is that what you're saying?
Oh, forgive me. I'm getting the SEP numbers mixed up. Thank you.
Yeah. Yeah. So I think it's 23,000 if you're in a 401k. The SEP IRA gives you higher limitations. Well, let's just talk about how we contribute money into those things. So there's a limit to how much I can put in, but into my 401k, is there a limit outside of my ability to make the payment? No, there's no limitations. I can contribute as much as I want to into that. And so I think of like when I'm building an asset, do I want to be limited by how much money I can put in it? Or would I like to be able to put as much as I possibly could, Joey?
As much as you want.
Right. So I think that that's a big a difference between building assets, right? We talk about buying real estate versus investing in the specific tool. Well, Ernie, you talked about the fact that early on there was tax deductibility in the contributions that we make, right? There's a contribution. I get to reduce my taxes by either the $23,000 for the 401k or $69,000 for the SEP IRA. But also, if I'm itemizing my taxes, I'm over the standard, allowance there. I'm deducting the interest, right, portion of my loan of my lake house. So I'm able to get both of those, but I'm not limited by what I can put into it on the real estate side. I think that's a huge difference that we don't ever consider. So
are you talking about like 401 lake houses? Is that what you're talking about?
Well, I'm just talking about a 401 lake house. Yes, there's no limitation to me having multiple lake houses. And let's just start with one. You start talking about multiple, my wife is going to come up here and smack me across the head. But yes, you can have the 401 lake house can have a kind of an unlimited amount that you're putting into it.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
So let's recap this really quickly. I want to go through a case study, but I want to make sure that everybody's following us as we do this. Just using the example that you guys gave. Whenever I put money in a 401k, I get to reduce my taxes by the contribution. Whenever I make a payment, right, the interest portion of that payment on the mortgage for my 401 lake house or condo or beach house, whatever, Mark, I can reduce that, right, as an interest deduction. That's allowable as well. Whenever I have growth on it, Joey, you talked about that each one of them have the potential to grow. One is based upon the market, one's based upon real estate. But as it relates to accessibility, I have to wait till I'm 59 and a half, or I'm limited if I want to take a loan, as you said, Mark, up to 50,000 or only 50% if I have less than 100 grand. But in my lake house, I got keys, right? In the 401k, I got restrictions, right? I got 59 and a half penalties. But in my lake house, I got keys to access it anytime I want to. And I can always go get a home equity line of credit. I can always refinance it out. I can pull the equity out. I don't have any limitations of when I want to do that. As far as time, I can do that. I have the ability. But also, we talked about statements and memories. The 401k, I got the statement. With the 401 lake house, I have pictures. And Ernie, you were talking about what happens at the end, right? When I sell it, I have to pay ordinary income tax on the 401k, but in the 401 lake house, I get the capital gains tax. Or if I die with it, my kids can actually access it with a step up in basis. Or if it was an actual investment property, I can roll that into another property, right? And not have to pay the taxes at that time. Here's another thing when we talk about contributions. And the contribution standpoint is who makes the contributions in our 401k? Well, I put up money and potentially my company, if I'm an employee, can match a portion of it. If I'm a business owner, I put up 100% of the money. Nobody else contributes to that plan, nor can they. But you know, guys, that in my 401 lake house, that I can have others make the contributions, and I can have them make the contributions in many ways. Like here's an example. As a business owner, you probably have a number of different people who refer you business already, key customers. Could you not send them down to your lake house or your beach house for a week, bless their family? And as a result of that blessing, did they not think of you in probably a pretty good light? And they go, you know what? I think that Mark is a fantastic guy. I'm going to keep sending him business. And those referrals, in essence, are paying the payments for your 401 beach house, Mark. Also, you can use the lake house in many different ways. You could actually rent it out. Most of these properties, you could probably rent out 1 week out of the month, and it can make the payment. So someone else can rent your lake house from you and contribute to its value, and you not have to make the payment at all. That's not available in the 401k. Or you can also rent it out to your business up to 14 days and not even have to pick up the income tax if you're using it based upon the prescribed limitations around that. And it can help make the contributions for you. So I see all of these different options. And we already talked about the fact that our families and other families can participate in this where it's abundant in that regard. But in the 401k, it's pretty selfish. It's pretty limiting. There's a couple of people out there that said that it's one of their favorite assets. I think it's probably one of the worst assets out there. And not only because of all the things we just mentioned, but also because it can't create passive income. It can't reduce your monthly expenses. And I can't have any of those other things. All right, let's break down a case study. Will you guys help me as I break this down? If you're not watching this on YouTube, you're going to have to go watch this on YouTube to gain the value of this case study. But I'm gonna share my screen here so we can talk about how can someone use the 401k or 401 Lakehouse as compared to the 401k, and how does it end up working out? All right, I'm going to give you guys a case study. This is an actual case study of a home that I owned. Now, what I'm not going to give you is financial advice or tax advice. You need to consult your own financial professionals, tax professionals for your own situation. This was just my numbers, my situation based upon the tax professionals and financial professionals I consulted with. All right, let me share my screen here. So if you're not watching on YouTube, you need to go back and watch this specific thing because this is definitely going to give you probably a greater visualization into why I was doing what I was doing. So most people contributed to a 401k because they were told so. And the one thing that they're told that they get from a 401k is that they get to reduce their taxes by the contribution. Well, when I was paying payments on my Lakehouse, my interest payments were 100% deductible against my taxable income as well. Now, since 97% of every payment that I had for the 30-year mortgage in those first couple of years was interest, I basically had the same contribution deduction as I would have had if I'd put it in a 401k, assuming I could have contributed to a 401k. Second reason people use a 401k is because of the match. My employer will contribute money in there, maybe, right? Maybe up to a certain percentage. Well, my Lakehouse actually had other contributions. Other people were making contributions into this. You're like, Russ, what do you mean? How's that even possible? Well, rental income, right? I could rent my Lakehouse out. Now, I did rent it out. I rented it out to my business 14 times, and I'll show you that. I used that Lakehouse as a way to bring people down, to have conversations around business, and it was a great tool for me to use, especially during 2020 and 2021 when there wasn't a lot of great options of places that I could go and meet with people. Also, I was able to send people down to that Lakehouse, and those people who are referring us business in the companies that we own, they, in essence, indirectly contribute to the payments because every time they refer me another person because they love being at my Lakehouse, that is one contribution, is $1 that I can use to help make that payment. Pretty creative, right? Now, people invest in the stock market through 401ks. That's its growth mechanism. A Lakehouse is clearly subject to the real estate market. Now, when it comes to sharing, in a 401k, you've got statements. But in my Lakehouse, I had pictures. I got lots of them. Some of them are digital. Some of them we've printed out. We've put on our walls in our homes. In a 401k, you usually have as relationship to access, you have restrictions. Most plans will restrict your access up to 59.5, and you have to be separated from service. But in my Lakehouse, yeah, I had keys. I could go in anytime I wanted to. As long as I could get down there, I had access to it. Now, as it relates to taxes, if I would sell my 401k, assume I met all the requirements, I would end up paying ordinary income tax. And in today's bracket, that would be 37%. As compared to my Lakehouse, I was subject to capital gains rates. Now, had I sold it in the first 12 months, I would have been subject to ordinary income. But when I sold it after 12 months, I could sell it at their 0, 10, 15, or 20% capital gains rate. So much lower rate of tax. Now, if I would have died, if you have a 401k and you die, my accountant has told me it is the absolute worst asset, Russ, that you could own is any type of qualified plan. 401k, SEP IRA, doesn't matter, because not only would your heirs who receive it be subject to paying the estate tax on the dollar, but then they're going to pay the ordinary income tax. So at death, your heirs get a step up in income. Whatever amount is in that account now goes on top of their income. So if they weren't already in the highest bracket, congratulations, they are now. Well, with my lake house, if I would have died and handed it over, my heirs would have get a step up in basis. Meaning if I would have bought the house for $1 million and it would have appreciated to $2 million at my death, they wouldn't have to pay tax on the $1 million to $2 million. They would get a step up in basis. If they sold it that day, they'd pay zero tax because they would be able to sell it at $2 million, and that's what their base is in it. Lastly, from a legacy standpoint, if you die and you pass along your 401k to someone, they're going to have money. Good. They can go buy what they want. That's kind of like, I'm sure at Christmas time, you give all of your friends and your wife, your husband, your kids, you just give them gift cards. That's what you want to give them. You just want to give them gift cards. Let them just go buy whatever they want. I doubt it, right? It's probably not going to fly in your house. Now, if it was up to me, maybe I would because, I don't really think through all that stuff, but my wife, 100% no. She's always going to want to buy specific gifts for them. That's what you get with a 401k. You're going to leave just money behind. But in a lake house, you're going to leave memories, both the old memories that they had with you, but also the new memories that they can make with their families. Now, let's get into some numbers here because I think this is what you really want to see. So here's the actual case study. I bought my lake house in July of 2019. My purchase price was $900,000. The down payment was $140,000. My monthly payment was $4,100. I did rent it out for $53,000 over the 14 days, and I sold it in October of 2020. So whatever that math is, like 14, 15 months after the fact, I sold it for $1.1 million. So if you took all of what my net proceeds were after all the fees, I ended up making $289,750. Is that good? Well, let's see if it is. So I put that in a financial calculator and I say, okay, I put $140,000 in month 1, and month 16, I take out $289,000. And every month between month 2 and month 16, I had to make that $4,100 monthly payment. What was my ROI? My ROI on this was 42%. Not too bad, right? Some of you guys were like, well, yeah, but my 401k has probably gone up something similar. Well, let's compare. So I went out to the market. I went and looked and said, had I put $140,000 into the market, the general market, the S&P 500, and I would have made a contribution every single month for $4,100 after that, how much money would I have? And so it showed me that my annualized return over that period of time would have been 11.1%. So I put that in my financial calculator, and it said I would have had $234,000. So let's go back and compare. Before taxes, my 401k would have had $234,000, but my lake house, remember, had $289,000. Oh, it's a little bit different. So after taxes, if I would have paid ordinary income tax at 37%, my 401k would have had $149,000, where my lake house, after paying 20% of capital gains tax, had $231,000. Do you like 149 or do you like 231? That's the comparison. Those are the actual real numbers had I been able to sell the 401k. But is it really that, or is it even better? If you've watched any of our videos, we've talked about the way that we buy all assets. We use a concept called becoming your own banker, the infinite banking concept. So I had my money in dividend paying whole life insurance with mutual insurance companies, meaning I was an owner of the company. My cash values were in these insurance policies. I have ownership in over 30 insurance policies. I have all these cash values. So when it came time to take the $140,000 out, I didn't take a withdrawal out of my cash value because then I would have stopped the earnings and compounding growth on that. No, I went to the insurance company and I said, send me a check for $140,000. Only 2 questions they asked is, where do you want us to send it? And can you confirm the amount one more time for us? Now, what they do is they put a lien against my life insurance cash value. And they're like, cool, you got more than $140,000 of cash value? We'll give you that money. And they say, not, hey, we're going to send you a statement every single month and you have to make this payment. Otherwise, we're going to come and repo your or foreclose on your lake house. They say, no, this is going to be an interest-only payment. And this interest-only payment is unstructured meaning that if you don't pay us back, all we're going to do is keep reducing your death benefit by the amount of the loan balance that you have. Not too bad, right? How many of you are using your death benefit as you live? Well, if you're using infinite banking, you are. And when is it that we really want our death benefit? When we're living or when we're dead? When we're dead. What do we want? We want access to the cash. That's why this concept is so powerful if and only if it's structured properly. If you haven't set this up properly, go to what'swhatwallstreet.com/free call, and you can jump on a call with one of our coaches, and they can show you exactly how to set this up correctly. So what did I do? I took that cash and I went over here and I made a down payment on a Lakehouse. If you're watching the video, this is going to make so much more sense. If you're listening to me, I know it's a little more difficult because it takes me a while to write it down. But I put that $140,000 and I bought the Lakehouse here. That's what was happening. So what did I have to do? I had to pay interest back to the insurance company. So I paid interest on the $140,000 each and every year. Now, I didn't actually come out of my pocket, but it was the same as if it came out of my pocket. So I went ahead and calculated it. So instead of a 42% return, I had to go back and add on my interest payment was $586 had I made it every single month, which I didn't, but I could have. If I added that to the $4,100, I was paying roughly $4,700 a month for the mortgage payment plus the interest payment on my down payment, kind of like a second mortgage, if you will. So now at the end of the 16 months, I didn't get to keep the full $289. Why? Because I had to pay back the $140,000 that I had borrowed from the insurance company, right? Makes sense? So I had left over $149,000. So what was the return then of me making interest payments to the insurance company, basically interest payments to the bank, and getting $149,000 back net in my pocket? My return was not 42%, it was 117%. When we talk about why do we use infinite banking, it's because we're using other people's money. But the importance was if I would not set up this insurance contract, I would have not had access to that cash. If I had it in a 401k, I wouldn't have had the $140,000 to make the down payment from the insurance company's money because I wouldn't have had the cash value to support it. This is why we use this process. I hope this case study was super helpful to you. All right, Stallion, we need to get final thoughts on this 401 Lakehouse versus the 401k.
I always tell you, if at this point you think you want to just invest in a 401k or a qualified plan of any sort, as opposed to what Russ just outlined and what we've kind of beat up like a dead horse, I just don't think you can be helped. You know, you don't like freedom. You don't like passive income. So just don't do this if you don't like any of those things.
Mark, final thoughts.
It's fascinating to me that in today's world where Amazon cannot get you the things that you want fast enough, 2-day is too slow, same day is not fast enough, I want it yesterday. I'm still surprised that people are willing to wait until they're 59 and a half or later to start enjoying these types of opportunities.
Wrong. Aaron, final thoughts.
Yeah, hearing all this, honestly, I feel sad right now. Why are we doing this? Why is the 401k the primary place that people are parking their money? SEPs, Simples, 529s, 403bs. Why is that where everybody's going? I think it's just because it's the only thing that they know. It's the only thing that they got. So if you're hearing this and this is resonating, maybe you know this, maybe you're hearing this for the first time. Who are you thinking about who needs to hear this next? That's my final thought.
I love that. All right. Well, thank you guys for listening. Hopefully you got a chance to watch this on YouTube. Go back and listen to these points again. We'll break them down so that you can simply see them and you can apply them into your life. Not that this is perfect. I'm not encouraging you to go buy a Lakehouse today. Please don't say to your spouse, Russ said, buy a Lakehouse. Or, tell them that Joey said it. If you do, don't say I said. But it's definitely a little bit different way to consider what is possible as compared to what is being told to us. Thank you for listening. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset. and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.